Good morning. Kemboy, can you hear me?
Yes, John, good morning. I confirm you can hear you.
Okay, then. Thank you. Thanks again. I would like to welcome you to the fourth webinar that the Institute of Economic Affairs is hosting this year. And today's webinar is actually a continuation of the what we call the Industry 254.
John, you are muted.
Okay, sorry. So what I was saying is that so today's webinar is actually part of the series on Industry 254 conversations. This is a webinar, a monthly webinar that the Institute of Economic Affairs has been hosting or holding since I think October last year. And so, of course, we continue with that in the course of the year, and so this is held either in the second or third week of every month. So yes, my name is John Mutua. I work at the Institute of Economic Affairs as a programs coordinator, and so I would like to welcome you once again to today's webinar. Again, the speakers are actually the two people that have been hosting this webinar. That's Leo Kemboy, who is a program officer with the Constitution Law and Economy Program, and our Chief Executive, Kwame Owino. So these are the two of them will be the speakers of or presenters of today's webinar. So the title is actually Standard Levy as Quasi Tax and its effects on industrial growth in Kenya. So I'll not get into the definitions and the rationale, the objective of this, but we know that increasingly the quest for revenue mobilization is an important one for the nation and for many low, middle income or developing countries. And for Kenya, obviously, that movement towards standard levies is something that has been growing. So the details of the discussions, obviously, I'll leave that so as not to preempt the discussion. I'll leave it to the two presenters. So what we'll do, the two presenters actually, we will have Leo Kemboy going first, who will present the main arguments, and then Kwame will conclude with the policy lessons. So before we get right into it, like we've always done in our webinars, so of course this is recorded for obviously purposes of archiving, but also for those who are not able to participate in this, to be able to go back and just review it, which we'll post obviously on our website. The usual drill in terms of housekeeping, they will take about 40 minutes or so, and thereafter we will open it up for plenary. If you have any questions as we go along, please utilize the chat box or the Q&A provision, and you can jot down your questions or comments. But obviously we'll have that session where you can verbalize those questions. So without further ado, I would like to welcome Kemboy to take us through his first part of the presentation. Thank you.
Thank you, John, and Happy New Year, everyone. This is our first webinar for the inaugural webinar for the Industry 254 series, and our discussion is something that happened towards the end of the year, and we were not able to schedule it for discussion, which is the question of the standards levy order, and primarily how it would affect industrial growth in Kenya. So we've split our presentation into 4 parts. we'll have an introductory part. For every legal question, we have to subject it to our own constitutional test. And then we'll have the main argument, which is the economic analysis part. Then we'll have what it means for policy. As you all know, we are as the institute, we want to be in the middle of Kenya's public affairs that affect and be able to influence it in a way that affects positively the lives and the welfare of Kenyans. So the Standards Levy Order 2025 sets out the imposition of the standards levy, and of key issue is that the standards levy first introduced in Kenya close to 35 years ago. Its main aim was that all these levy, the collections from this levy would be used to develop industrial standards. It was meant for standards development. So want to make first the distinction. Standards development is a public good, and a public good is something that government is required to fund because of this main reason that the marginal cost of funding that public good is lower than the marginal benefit. So private sector will not necessarily be able to fund that. So section 42 of the standards levy sets the levy at 0.2% of what we call essentially it's customs value of goods manufactured or services, but before tax and before discounts. But what that means is that just get price before anything is done, before it's sold, before tax is paid, before anything is done. And then the other main question is the deduction at source, and it's supposed to be paid by 20th of the following month. The standard levy in this case is a revenue earmark. An earmark is a public it's a public finance categorization. Earmarks are funds that are specifically ring-fenced. So you can, on the expenditure side, you can ring-fence. Also on the revenue side, you can ring-fence. So in this case, the standards levy has been earmarked for standards development, which is basically to fund the operations of Kenya Bureau of Standards. So the standard levy in this case is an earmark, and the earmark has its problems with public finance. So another question that we asked ourselves is, if this thing called standards development is a policy question, how much does it cost to? How much does it cost for Kenya to pay for standards development? So we went through the budget books, and if you look at 1175 for the State Department of Industry in the program based PBP, you find that for standards metrology and conformity, that in 23-24, the government of Kenya allocated the 650 million shillings was allocated, and then for 24-25, 364 million shillings, and then 683 million for 2025-26. So we need to understand, because this is very important, that when the government of Kenya puts in a levy, provides this extensive framework to collect it, how much is it looking at? So if you look at that, the vote line just after industrial promotion and development, 03, 21, 010, standards metrology and conformity in the chart, you'd be able to see how much it has costed government of Kenya to fund standards. So for 683 million shillings. So we want to do an economic analysis for you to be a constitutional test, a political economy, and also a general economic analysis for you to be able to see whether that 683 million shillings is an effort that government of Kenya should spend on. So as we've spoken, in this case, the standards levy is an earmark. And the political economy of earmarks is that the first question is that it shields agencies from the annual budget certainty. So the uncertainty. So you remember, during the budget process, agencies and government institutions present their draft budgets to the working groups, and then it goes again higher for parliament to determine whether those specific agencies should be given those specific resources. Apologies. So those specific resources should be whether that should be appropriated to them. So once you have an earmark and it goes for standards development, that has been shielded away from the public. Now MPs cannot question even the process of appropriation, determining whether in the first place those functions should be funded or what scope should be funded. The second question is the question about, because this is titled as standards levy, it is difficult to sell in the general public finance management. The discussions around taxation is that it's difficult to sell taxes to general public. So you find another route that the general public will not be able to year-on-year basis query the relevance of that tax. It becomes difficult to examine that question. The third is that it becomes difficult to track outcomes, because here you've dedicated a levy, you want to develop standards development. It becomes difficult to track whether the process of developing those standards has been achieved, because earmarks, it's difficult to link the revenue collection process to the establishment of the earmark. The fourth question is that it's sticky and difficult to reverse. So revenue earmarks are sticky and difficult to reverse. Remember, this was instituted in the middle of when Kenya was undergoing reforms due to public debt pressures and many other institutional problems 35 years ago. But now that has stayed on and is a permanent feature. It's now a permanent feature of Kenya's public finance management. Then another issue is the extension of powers. So you find that while the scope is on specific manufacturing, that this is on manufacturing, you find that at one point that revenue earmark now becomes a tool for collection of revenues. So these are the general problems with earmarks that we see from the political economy side. But the one that stands out is the one that it's difficult to reverse. It becomes a permanent question, even with sunset clauses. it becomes so that Kenya is still one generation later, still on the process of developing standards. Now, is standards levy a levy, a service fee, or a tax? What we see is that because it's compulsory for all manufacturers, non-payment results in penalties and civil debt. There is even convictions related to that. And that it's, and unlike other taxes, it's specifically earmarked for standards and also used for KEBS operations. It also has a requirement, a compliance question, which is that you have to register, you have to continue to pay, to issue monthly returns for a determination of whether of monthly returns, whether you're compliant. It provides that administrative tax on time. Then here, while it's earmarked as a levy, it's actually it's actually a tax because it functions in a similar manner, that it increases those production costs. And therefore, if it's a quasi tax, which is generally it's a general tax, then we have to to provide a constitutional test, because for any tax to be imposed in Kenya, it has to fall under the Article 210 of the Constitution on imposition of tax. Remember, Article 209 provides that the government may charge for fees for use for government may pursuant to legislation. But here, if you look at the characteristics of a tax and compare it to the standards levy, then it functions similarly as a tax. So because the levy is imposed through subsidiary legislation, it has a problem of it raises the risk of taxation through regulation, and not necessarily through the other parliamentary processes that through the robust mechanism that the other revenue raising measures go through in parliament, that it has to because once it's a tax, and it can only be once the constitution say that taxes can be only levied through legislation, it introduces other constraints. So you have to be binded by provisions of Article 201. You have to be binded by provisions of Article 118 on public participation. You have to be binded by other constitutional measures. So here, the taxes are being raised directly through regulations. The second question is, it ought to be challenged because of that, the express of fiscal authorization. Remember, it's seeking to fund standard development, and that standards development is a public good. Public goods ought to be paid directly by government. And in this question, can the same a specific tax to fund whether the appropriateness of that fiscal authorization is something that is a challenge. The third question is that it precedes the Constitution 2010. So for lack of words, one thing that ought to have happened is that harmonization. Whether once the chapter 12 of the Constitution, which sets out the public finance management framework, is actually entirely with this with this provision. The second issue is that while our Constitution allows delegation through delegation through Articles 94, allows for that rulemaking. It's very limited, and it's limited to very specific issues. So while the rate is specified, it's outside that primary legislation. So there is an extent to which, given the standing orders that guide the delegated legislation committee that reviewed the delegated legislation committee that approved this order, it's clearly that this points to an extent of that excessive delegation, because the process of delegation is limited, because the other methods provide for more robust engagements with the public. So there's also a problem of that the imposition of the assessment authority, because majority of the administration procedures are tied to the discretion of the director. So it says, it provides that the director should, once you want to opt in, you have to make an application to the director. The director will check for compliance. The director will check for whether those revenue raising measures has been achieved. And this case, it is the director of the standards of the agency in charge of standards. That is the challenge that it creates. So it creates administrative discretion in fiscal matters, something that which the chapter 12 of the Constitution does not anticipate. Then another constitutional test is that the levy is supposed to be paid on a monthly basis, but the exemption has been defined annually. So it makes it difficult for even compliance purposes. So there are farms, for example, that farms operate differently. That the others that have seasonal, the others that they sell on manner, because there's that dispersion, the widespread dispersion in the way farms operate. So there's a clear constitutional question about the legislative precision and certainty, and also accountability. The second question is, who bears the tax? The incidence. The incidence question, and we've added together with the distortion question, because remember, a tax in the end reduces the extent of the market, the size of the market, because once that is collected, it's not available for anything else. So the imposition of tax is that the problem with the incidence is that once you pay at gate price, once the levy it's levied at gate price, is that it doesn't matter whether you're profitable, it doesn't matter, all these other things do not matter. So loss-making farms still have to pay. So the levy is independent of profitability, as shown, because remember that the levy in this case becomes a part, is taken up from revenue before you net costs and other things. So in the loss-making farms still have to pay. And the incidents here, irrespective of what happens. So we'll discuss further in the subsequent slides about the pass-through, whether these farms take up the levy costs or they pass through to the others. But in the end, is that distortion, because this is an elastic, it's a tax on turnover. It generates larger efficiency losses than other instruments like the turnover, like the income tax act, especially given that manufacturing is in it's an heterogeneous product. It has what we call the heterogeneous productivity. There are many farms, but the margins are not the same. So, and productivity here is dependent on many other factors by nature of the production done, among other things. So the third test that we provide is the question of regression. So Kenya's manufacturing, from what we know from the literature, assessments by multilateral institutions, including the World Bank, is that there are three things that can be largely said about manufacturing. One is that there is high dispersion in productivity. There are many farms, but the farms are not operating at the same level. In fact, in one World Bank study, 2016, an assessment, a diagnostic of Kenya's productivity, there are farms that were found that could compete in upper and middle income economies comfortably without government subsidies. But on the other side, there are farms that really relied on government regulation to survive. So there's dispersion in productivity. The second thing is that there are thin margins, not just among SMEs, but manufacturing is generally as a margin-sensitive business. The third question is that informality, the difference between there are many other farms, what we call the small cottages or small sort of farms that start to value add. So there's a larger informal fringe. There's a sort of a middle that needs that productivity jump to be able to formalize and participate in the export market. So there's that large informal fringe. So when you want to test regression, the regressivity, you look at how the effective tax rate on profits. So you find that for lower margin farms, this rate can exceed corporate income. And even though the statutory level appears small. So just to demonstrate, so we had a simulation. So if you take, so because there's a limit, a maximum limit of that for those who have an annual revenue of 5 million shillings, start to pay this standards levy. We take three farms, same 5.5 million with the same revenue base, but with different margins, which is now that profitability, that what is available to them after they've netted costs. So if you take 2%, which is a low margin, 5% and 10%, and a levy of 0.2% of monthly turnover, you find that of 5.5 million, you pay something close to 450,000. Revenue on a monthly basis, something around 458,000. So the monthly levy will be 916 shillings. If you multiply by 12, that is 11,000. For profits, you take the margin multiplied by revenues. So you see the levy on one side for farm A, B, and C. The second part is for a 2% margin farm, it's 110,000. It's 275,000 for a 5% margin farm, and then 10%, 11,000. So the effective levy rate on profits is that the farm A, which is a low margin business, pays 10%, while farm C, which has an high margin business, pays 2%. So it's negligible for high margin farms, which are fewer. In the general ecosystem, we look at all manufacturing farms, high margin businesses are very, in terms of numbers, as smaller. So low margin farms pay an high effective rate on profits than high margin farms. So it mostly those already established farms would have an advantage in coping with that the compliance question of that. So we added a further simulation to ask ourselves, if we know that the largest burden is the corporate income tax, 30%, and of 30%, how would it look like if you, after you've added the compliance question with the levy? So if you look at the same farm, this is the same farm with the same revenue of 5.3 farms with the same revenue of 5.5, but with different margins. So if you take, for example, that the farm A profit of 110, the corporate income tax is 33,000, that is supposed to be surrendered to government. It's 2,500 for farm B with a 5% margin, and farm C with 165,000. So if you take the total tax burden for farm A after adding the levy, 11,000, it will be 44,000, and then farm B, 93,500, and then 176. You see again, for low margin businesses, the overall tax burden, even after accounting for profit, is still higher. And this is a simulation to just demonstrate the effects. The fourth analytical approach is the pass-through, whether the farms can take up the cost or they're able to pass through. So we know for competitive markets, farms tend to set prices closer to the marginal cost. So the prices are closer to the margin. So when costs rise, the supply curve shifts upward, and this reduces the quantity supplied. In essence, what it means is that it's for at competitive markets, the pass through is almost they're able to pass through to consumers at almost at 100%, closer to 100%. But that degree of pass through depends on questions about inelastic demand. So like fuel, like in other areas. And then also the market power, the size, the extent of market market power. So for monopolies and oligopolies, they can pass more than perfectly competitive market. So there's a cost implication for farms, but that is also passed through to the consumers. The fifth question is about the now institutional compliance. If you look at sections 9, paragraphs 9, 10, 11, and 12, it's a question on registration, certification, and continued operation. So there's a compliance question. You have to register, you have to fill those forms, you have to ensure that you are always in compliance. So it introduces a compliance risk where certificate could be cancelled. There's also a question about monthly reporting, so that to be able to know whether you are eligible, what amount of levy you are supposed to pay. So there's an non-trivial fixed cost of formality, and this raises the cost of it. This is a problem of too much compliance. The big question for government, especially this government, the government of Kenya, that the current administration, is that there are too many compliance questions that needs to be raised, that needs to be reduced. So we are in a meeting, and one of the manufacturers was speaking and complaining about how they have to comply with regulations of more than 18 regulatory agencies. So this is one of them. This is one of them. Because there's a compliance question, because once you fail to meet one of those conditions, your certificate could risk being cancelled. Another thing is, when we looked, if you look at the first schedule, which determines the classes of manufacturing that are required to pay for these costs, we realized that the other things like road construction, the construction services, software development, issues on repair and maintenance, design and advertising services. So they've interpreted manufacturing as a broad class. Other things, essentially, if you look at the UNCTAD, the UNIDO definition of manufacturing, and if you look at even the classes of manufacturing and compare to what is in the order, you'll see that they've overextended the scope of the levy. Yes. So any tax measure should, which a core principle of optimal taxation is that tax instruments should target the market failure that they seek to correct. And here we don't see that. We don't see that, and that's a challenge of that's a political economy problem that is emerging from this from the standards levy, because now they've broadened the definition, and then almost everything else is put in back. And then the gatekeeping role, if you read the levy order, the number of times it mentions the director, and essentially that's the regulatory gatekeeper who approves registration, issues compliance, ensures that levy collection, penalties for non-payment, monitors manufacturers' returns for accurate turnover and levy reporting, and then interpretation of that class of manufacturing, but also cancelling certificates, which gives that the director the power to create influence over farm behavior. And then these roles conflict for the interest of manufacturer. So thank you so much. I end at that now. Comment. Back to you, Kwame.
All right. Okay. Thanks, Leo. So I think so our audience has understood that one, this levy was proposed prior to the present constitution. The administrative convenience, which determined how it was introduced, has significant implications for how the the levy is applied. The third point that we tried to make is that while it is called a levy and designed as such, from the standpoint of economics and the production levels for farms, it is effectively a tax. And it is a tax not only because of the incidence, but because it affects the production costs, and it is split, or rather, it is spread across all the goods that a farm and the services that a farm produces. And for that effect, we might call it a levy and administratively apply it as such, but it has a consequence of a tax. And so analyzing it as a tax is prudent, and not just prudent, basically useful, because then it shows us what its effects are. We also noted that, well, because it is a tax, it has been levied at a certain level, basically an ad valorem, like 0.02%. That might seem to be trivial, but it has consequences for farm sizes, and it has consequences for us given farms profitability and operational costs, because it is regressive in the sense that the smaller a farm is, the higher the burden is for that farm. Now, why is that important? Why that is especially important because Kenya's manufacturing sector, just like in most its business sizes, most businesses tend to be on the smaller side, and therefore its consequence and its effect on a smaller business are much, much larger than it is for a big business. Now, it is not the big business's fault, but basically the design ensures that it then therefore becomes a far bigger constraint to the growth and the profitability and the ability to create value on the smaller businesses. So it tends therefore to have that effect. Now, whether that was the intended effect or not is not is a different matter from the fact that the reality is that it has different consequential. I mean, it has different distribution costs or distributional consequences in terms of the incidence for businesses of small sizes relative to those of a bigger size. And then, of course, the administrative effect. I think we at the Institute of Economic Affairs have maintained that if you look very, very carefully at Article 208 and Article 209, which allows for Parliament only to make sure that taxes or any levies are charged based on a law, are not just based on a law, it is not clear to us that rule, especially the discretion, that Parliament has the discretion to actually pass its tax-making role to another firm, to another arm of government, even if it passes a law and through that law allows discretion for, might it be a Director General or any other administrative body or even the CS to vary the tax. It is our contention that is illegal transfer of parliamentary authority to other institutions. So as the Constitution exists in Article 208 and Article 209, even were Parliament to do that, it would be an administrative, unconstitutional surrender of constitutional authority from Parliament to whichever arm. And we suspect that given especially that this levy was applied or rather was designed with good intent prior to Constitution of 2010, to the extent that that Constitution changed the responsibility and the authority to levy a tax or a levy, to apply a tax or a levy, it stands in uncomfortable ground as it is. So that's basically it. So what are the policy lessons given the simulations that we provided, its effects on total taxes, and its effects on total profitability and its effects on small farms? One of the policy lessons that we see here is basically, the first one obviously has to be on how these levies are designed. It's clear to us that the design is not only constitutionally troublesome, it is also on the basis of sound economic analysis inefficient. So the first thing is basically we should remove these earmarks and the levy should be evaluated as a tax. And also because the setting of standards is itself a public good. It's a public good in the sense that once standards are established, all farms within a sector and all consumers of a product, basically the demand side and the supply side, would benefit from it regardless of who pays for it. That usually points to the view that the design of the tax should actually be as a general tax and not necessarily at based on collected from the supplier. There might be convenience from this collection of the supplier or for the administrative convenience of the body that collects it, in this case the Kenya Bureau of Standards, but the design of that tax is fundamentally difficult. Is fundamentally erroneous. And our view then is that if you're to do that, then we should fund standards development from the main taxes because it is a public good. And let's accept that, yes, standards are essential. We cannot do without them, but basically you should take it away from the design as it exists now. It is very, very inefficient. It has aggressive effects, and the distribution of taxes across different people and different farm sizes is something that Parliament should make as a political choice. For that reason, it should be standard setting should be funded as a public good. You also create perverse incentives when you allow an administrative body, in this case, they say Kenya Bureau of Standards, doing its technical work to have to determine or have to set taxes and its discretion in a way that actually supports its bottom line, because then you create a perverse incentive for those taxes or that levy to be designed in a way that is not necessarily the most efficient. So again, there are many perverse incentives. So in our view, Parliament should evaluate the use of sunset clauses for the standards levy and all other levies. We are arguing that given that this tax was designed in 1994, soon after, for the purposes of supporting Kenya's development of standards, which was justifiable at that time, we think that a generation later, 30 years and a bit after that, most of the standards that need to be set have been set. So we are not too sure that it's supporting that purpose. And it's clear to us that now it's supporting, right now as applied today, it mostly goes to the bottom line. That's one. Two, it is difficult to determine whether the amount of money that comes in on 680 million is what is intended for this year's financial year that ends in June. It's not clear to us that the same amount of money is necessary. So the incremental cost of establishing new standards does not justify the expenditures of 680 million. And so for that reason, we think it's good practice for all taxes to be set with sunset clauses, and levies, especially of this kind, require sunset clauses so that Parliament can reconsider its redesign. And we think in the end, actually, one of the things that we're left with is no choice but to repeal the levy. It's not, to me, that's not the same as saying that the Kenya Bureau standards should not be set in those standards, determining technical standards. But this levy should be repealed for the reasons that we mentioned administratively, its effects, regressive effects, and obviously on the other side, because of the creep, the dangerous creep on constitutional authority granted entirely to Parliament. Yeah, so that's basically, those are our major conclusions, our policy conclusions. So, thanks. Thank you very much.
Back to you, John.
Oh, thanks. I thought there was a number, slide 17. Anyway, oh, it's references. Okay. So, yeah. So thanks both Leo and Kwame for taking us through. Just basically laying down the argument about the effects of the standards levy on industrial growth, and just a quick summary of basically what I picked from this is no doubt the argument that the two have presented is that the design of this levy and obviously given what it is, it's basically a tax given its effect basically. So basically what they are saying is that running this levy through, Leo took us through, it's a 7-test, subjected it through a 7-test run. Obviously, it falls short on a couple of things in terms of the constitutions, the burden, and the fact that it is also regressive, and it provides discretion and so on, and increases compliance. And the firms that are affected the most are obviously the low margin firms. Given all this, there is need to repeal its design. Given the challenges and the fact that it falls short on this 7-test run that it has been subjected to. So obviously the debate and argument is that there's need for Parliament to relook at this levy and for it to be repealed and redesigned afresh, just to ensure that obviously standards development goes on, but not in the current in the way it is currently financed. Okay, so I will now open these up for plenary, and I would like to invite any questions or comments from our participants. So far, I do not see any. Of course, you can either use the chat box Q&A provision up there, or raise your just unmute yourself or raise your hand, and I'll be able to spot you. Yeah, so feel free to raise any question. For instance, if there's something that was not clear, you can seek clarification from the two presenters. Yeah, or if you have a comment, feel free to make that comment.
John, good morning.
Yes, good morning.
My name is Ruth from Kenya. Just wanted to maybe seek clarity from Leo. I've seen quite some mathematical calculations and were a bit confusing. Maybe he can just maybe take us back there and calculate and just explain further so that we're able to understand and get a grasp of what exactly he meant.
Yeah, thanks, Ruth. I think I will also throw in one. So I mean, to either of the two presenters, I'm just wondering why are such like levies, why they've escaped scrutiny and oversight, particularly from Parliament or even any discussions in the public arena. Maybe you could respond to that as well, either of the two. So start with Kemboi.
Yes, John. So yeah. The reason why Parliament, the scrutiny is that if you look at the standing orders for Parliament, the Delegated Legislation Committee, when a legal notice is brought before them, they can either agree to it in totality or actually reject it as it is, but they cannot amend it, or they cannot. So most of the time, and given the way Kenya is in fiscal distress and revenue raising measures, the more the merrier. Something like this will sail through without a lot of difficulty. And that's why these other questions about incidents, distortion, how regressive it is, it will not be a big question as such, because the delegated legislation committee is the one that considers all these, mostly the legal notices. So, yeah, if you want to look at effective, whether it's regressive, you are looking at the effective tax burden. So remember, we know that the SMEs have thin margins. So margins is like what is available after you take out all your costs and everything else, what is available for the farm. So you can take a 2%, you can take a 5%, you can take a 10%. And this is common for majority of these farms. So if you take the levy rate multiplied by revenue over profits, you'd be able to see what is the effective tax rate on the levy tax rate, the levy on profits. So here, so we've taken 3 farms. We've made an assumption. There are 3 farms that exist, and all these 3 farms have the same revenue base of 5.5 million shillings. Therefore, they are required to pay for the levy as per the Standards Levy Order Act Standards Levy Order 2025. So out of that 5.5 million, the monthly turnover comes to around 458,000. So for that 458,000, that 0.22% would be like 916 shillings. So it's a very small amount. If you multiply by 12, it comes to 11,000. But now we want to test how it affects profits. And if you have a margin of 2%, 2% on. So for farm A, it's a low margin business, 110,000. For farm B, it's 275,000. For farm C, 550,000. So and if you take that, because that's what is available for them outside everything else. If you take 10% of it, of those, of what is of the markup, 10%. For farm A, it's 10% of the markup. For farm C, which is an high margin business of 10%, it's 2% of the markup. So we wanted to see how regressive is it? Is it? How is the tax burden shared, given the fact that we know that manufacturing is a margin business, and margins are not the same. They have those with very good margins. The proportion that they'll pay is very small, but there are those with huge margins. The proportions they pay is significant. So this was for us to illustrate that it's not the same, because people say the amount is too little, the levy amount is too little. But when we come back to look at the markups and look at what is available for the rate is significant. The second question is on, now, what if we say, before even we consider the other tax burdens, how does it affect the overall tax burden, which is the company income tax, CIT, which is what you pay in the end? So if you look at it, is for a farm that profit is 110,000 is 33,000. A farm that profit margin, the margin is, if you look at the margin, it's 5%, 275,000, and then 550,000. So the income tax is 33,000, 82,500, 165,000. So if you look at that, if you take the levy, without the levy, they would pay 33,000, 82,500, and 165,500. But if you had the levy part, you see that the effective rate on profits changes. So the others would pay 10% more for the low margin business, and while for the higher margin business, it's smaller. So there's a disproportionate, there's a regressive factor in this, and it all comes by this reason that, as we know, manufacturing firms, it's a margin business, and they're margin sensitive. And then there's a difference of dispersion in productivity. There are firms that the winners and the laggards, they are those ones that it would do even extremely well if those similar firm is set up in Taiwan. But there are those similar firms that struggle because of regulation, because of many other things, cost of doing business, among other things. So that is the math to just show regressive, because once we like to demonstrate this empirically, because most people would ask questions, how is it regressive? So we show that by just having a margin of 5%, a margin of 2%, and another one having a margin of 5%, of 10%, there is a big difference. Yes. So, and this, the margins is just for us to is our own calculations. It is something that comes from our own calculation, given the fact that we know the adjusted risk of return in Kenya is like 14%. So you know that where the margin would be. If you look at interest rates, if you look at the other factors, where the most margins would lie. So yes. So because we need to demonstrate that manufacturing is not, it's not the same. You can have a very big plant, but the margins are too small. Yes. So this is just to explain the one on regression. I hope I am clear. Ruth, you can ask You can state if you want me to do any more further clarifications on that before I give it over to Kwame.
I think it's well understood. Perhaps we can request if we can get the slides after the meeting.
Yes, and we can also say chat about this. So yes, Kwame.
Thank you.
Back to you, Kwame.
Thank you.
All right. Okay. So thanks. So I think Leo has demonstrated that yes, because of the way the tax or rather the levy is designed, which we still call a tax, it has an effect on specifically regressive effect, both from the way it is applied as a share of productivity. I mean, as a share of profits, and then if you add in the costs, if you add in the income tax, the corporate tax rates, then it also has a regressive effect in that. Now, it may have been that someone would say that, look, that means that you have an incentive, you're establishing an incentive for higher value farms and farms that add more productive, I mean, to that are more productive to get in. But yes, as we know, the manufacturing sector, and especially its reality in Kenya, there are many more farms on the small and medium-sized part. So those are the ones who are taking most of the burden. And this is one of the reasons why we say perhaps the redesign of this levy is overdue. So that's the first one. And John asked a question, which is basically, why is it that these levies have escaped the attention of Parliament? And I'd like us to all refer to Article 209 of the Constitution. And basically, this Article 209(2) states that first 209(1) states that basically only the national government may impose income value-added customs taxes and excise tax, right? So that's A, B, C, and D. And then it states in 209, Article 209(2), Sub-Article 2, an Act of Parliament may authorize the national government to impose any other tax or duty except a tax specified under Clause 3, which is basically taxes that the county assemblies or county governments are allowed to. Now, Article 209(2) has been traditionally interpreted by the executive especially, and Parliament has not pushed back, that once you give a right or you allow for the national government to say impose levies, then that means that by dint of that authorization, they can also set rates and determine how those levies are changed. But we don't think that's what it means. In the same way that VAT is imposed by the national government but authorized by Parliament. It doesn't mean that the minister should have the right, or the Constitution does not say that the minister has the right to actually change VAT from 16 to 9 without necessarily applying to Parliament. But it's an antecedent of what we had, of what the Kenyan nation had before the Constitution in 2010, where the Cabinet Secretary then called the Minister for Finance would actually be setting rates and Parliament would simply accept it. So we think Parliament has not stepped up to its new obligations or new responsibilities and powers under Article 209, and that allows for that interpretation to be, in our view, a little more loosely applied. So that's the first one, which is just basically legal text. The second one is a question of principle based on the fact that this Kenya is a republic, and that's this division of power, the division of a separation of powers. And if you look at separation of powers, something that's been legislated in Kenya, and which we think is one of the strongest principles of our constitution, of Kenya's constitution, to say that you impose a tax and then allow the same person who's collecting or administering the tax to set its rates means you're actually mixing the powers of legislation together with the powers of collection. And that, in our view, would violate the principle of separation. Because if that was to happen, then it means that the National Assembly has no role. It would allow the national government to both set the taxes, which means legislate, and legislation cannot be done outside of Parliament, and then at the same time. So to the extent that taxation is a legislation question, the setting of those rates, right, is by implication a legislation question. So when you allow a director or an administrative body to, on the basis of legislation, take that legislative right as well, and also to use it for the purposes of setting that taxes, I think it's a problematic area in terms of the adherence to the division of labor between them. So basically, we see that. And then the third point is a political economy point, which is if you allow a state to have the executive branch, which is definitely going to use this, the perverse incentive for it to use that money specifically to just raise taxes without, or to raise burdens on citizens with as little oversight as is possible. And part of tax oversight is to ensure that those taxes are consistent with what the citizens allow Parliament, or Parliament that is directly responsible for citizens, elected by the people's representatives, has a view about what burden they're imposing on the citizens, because they're going to have to do that. Now, a Director General, however qualified technically, at any state department or agency, has no political pressure directly from the citizens in terms of setting tax rates. And so that's why we find this problematic, both from the principles of economics, the constitutional principle on obviously administrative. And for that reason, we think the design of taxes should change. But I think Parliament is partly behind on the basis of antecedents. This was power that resided. Political pressure, or if not political pressure, the assumption by the Treasury that once you give those rules, you should. And they've also been set up to the extent that Parliament is being told that when it comes to levies and subsidiary legislation, they must accept the entire legislation or approve it in total. And there's no legal basis for the cabinet secretary or any other person in the cabinet to set that kind of legislative poison pill to Parliament, where you either take the whole or you approve it in total. I mean, that means there's no approval power. So that's basically the reasons. So they're the political reasons, they're the administrative reasons, and of course, they're the historical reasons. Thanks.
Yeah, thanks, Kwame and Kemboi. Yeah, Kemboi for that clarification, and Kwame on the addition about the question that I posed on why there's maybe little scrutiny from Parliament on such levies. I still don't see any questions or comments in our chat board. So again, I would like to invite participants. So I know time is it's now 12:15. So this is the final round of any questions or comments before I invite our speakers to make their final remarks. Yeah, feel free to unmute yourself or just raise your hand and I'll spot you. Wow. Do we have any questions? Okay, so we seem not to have any further questions from our participants. Of course, as was mentioned, this presentation will be posted immediately after we are done with the webinar. And you're of course invited to share any questions that you may have upon interaction with the presentation further. I mean upon further interaction with the presentation. Yeah, so I think what I'll do is now just allow our speakers, starting with Kemboi, to make their final remarks.
Yes. So yes. So in the end, standards development is a public good and should be funded directly from the exchequer and should not be funded through an earmark, a revenue earmark, because it creates distortions. It's a problem to administer. It empowers it gives more powers to the agencies. It's even so there's a problem, an entire problem, so that the essence of a tax should be that it should have the lowest level of distortion. They should know it shouldn't have directly create significant distortions or affect farms differently by increasing the overall tax burden. So there's a big challenge in that. So, and most people want to understand, even the fellow Kenyans who work in the standards agency, that you want the parliament to appropriate resources, enough resources for the standards development. It doesn't mean necessarily that by us disagreeing, we don't see the importance of the role of standards, but we have to be very careful with the way we make proposals on taxes to create that distortionary effect and stagnate the progress of Kenyan farms. Yes, and we will still, so partly we've studied, as John as I'd say indicated in the introductory part, the IES Industry 254 conversations will continue on a monthly basis, the second or third week. January was an exception, but for every month we'll be discussing issues that affect manufacturing and industry on on a monthly basis, and topical questions. So there are things we've learned from manufacturing farms, and we continue to learn. Among them is that they are margin sensitive. They are margin sensitive. Productivity is different. The other farms that are affected by imported inflation, they are primarily on the part of global shocks. Manufacturing farms take an 8-year horizon in terms of recovery of costs. So there are a lot of things that policy makers need to understand, and it's our job to bring them up to speed and to be able to bring in, because you don't make one consideration about standards while leaving all the other things on the table. So there are other things. It has to be a decision that, and that's why we endorse the core. Given the 7 tests we've provided for against the standards levy, we endorse the call that this should be repealed. Standards should be funded directly from the budgets, just like any other thing. And the question about revenue earmarks should, as a matter of legislative drafting into the future, should cease. It's earmarks. The questions about earmarks should be entirely done away with, except for specific cases where there is a broad consensus by broad consensus. So this power of using earmarks should be limited, and limited in a very big way, because we think constitutionally the delegation of power provided by Parliament, by the Constitution, to allow persons who are not members of Parliament to make rules is limited is limited, and in a way that you cannot use delegated responsibility to levy taxes. That is it's not something that is plausible. That's why we had Chapter 12, because those are the problems that the previous governments pre-2010 did, and the Constitution was drafted specifically that way, to limit that power. Thank you so much. Looking forward to seeing all of you in the next sessions. Back to you, Kwame.
All right. Well, so to finish off, our conversation today is essential, and I think a discussion on the discretion and power of government agencies to levy taxes in the name of levies and fees are important, because at this time, with public pressure on the revenues, of course, KRA is breaking revenue records, but as you can see, the deficit is not growing, is not shrinking. So what that means, obviously, is government expenditure is still far ahead of the revenue. And what that means is one of the ways in which that adjustment takes place is basically to ask agencies to raise money for themselves. And as we've seen, as designed, that could lead to substantial abuse and possibly revenues that are not necessarily connected to what the costs are, but more importantly, with the adverse consequences on employment and also the adverse consequences on farm growth. So that's one thing to consider. And the second thing is that we've seen that the number of levies over the years has been growing. And it's clear because we understand the perverse incentive for every organization or every agency of government to collect its own revenues. And so the constitutional questions that we raise together with the efficiency questions are things that we need to bring to the fore. And that's part of what we hope we persuaded you a conversation around should be started. Thank you very much.
Okay, so thanks a lot. So please help me to appreciate both the two speakers. You can use the icon up there on the taskbar. Okay. So I see a question. Is it from what's her name? Is it Susan? Do you have a question? Sorry, we are about to wind up. Okay. Yeah. So we so help me appreciate. I think before that. Okay. So I thought I saw somebody who had raised, but anyway, since we it's now almost 12:30. So time is long gone. So we will close here. But if you have any question, feel free to share that via our. You can send it to admin@ieakenya.org.ke, and we can have further discussions on this. Otherwise, thanks a lot to our two presenters. Again, as I mentioned, we'll post this presentation, and we could have other sidebars or conversations after the webinar. So just to mention, we will. There are two webinars that we will have this week. So please look out for those two. So on Wednesday, we will have a webinar that will discuss the question of sugar production in Kenya and the issue of protection versus local competition. So the title is basically Lessons on Trade Policies from Kenya's COMESA Sugar Safeguard. So please look out for that. So this will be hosted by our colleagues from the Trade and Development Program. And then on Friday, again, the issue of streamlining our public procurement system is one that is current and topical. So we'll have the Constitution, Law and Economy program actually that will be hosting a discussion around the launch of an assessment of the launch of electronic government procurement, looking at policy options and reform priorities. So this will happen on Friday this week. So again, thanks a lot for taking sparing time from your busy schedule to join us in this, and please we welcome you for the other two webinars. And for any other subsequent webinars, please feel free to visit our website and just look out for those in our social media platforms. So again, thanks a lot. The Institute of Economic Affairs is a members organization. If you'd like to be a member, please get in touch with our communications program, Oscar and Michelle, and they will take you through the benefits of being a member. We still have that info in our website, so feel free to visit that. Otherwise, thanks a lot and have yourself a good afternoon.